The psychology of dollar cost averaging. In India, the most common way of investing in a mutual fund is through something called an SIP, or a systematic investment plan, which is similar to dollar cost averaging. So why hasn't that taken off in the US? And wouldn't that solve a lot of problems related to psychology of timing and mistiming and all of that?
It does. Well, here's the thing about dollar cost averaging. If you back test it and look at history, it's almost impossible to beat dollar cost averaging. Exactly. It's just like, even with hindsight cherry picking, it's hard to beat it. So in theory and the data, it makes perfect sense.
Yeah.
But it's just so hard psychologically to do it, because when the market has fallen 20 or 30%, to keep making those contributions takes a lot of effort, takes a lot of mental willpower to actually hit buy and to actually do it. What's important is that dollar cost averaging only works if you are making those contributions at the market bottom. Those are the most important contributions that you make. And so I think it's always the case that it is easier to say, I will be greedy when others are fearful, than it is to actually do it. And if there are programs, and there are some of these in the United States as well, where you can really systematize your investing decisions and just set up an automatic plan so that you don't have to make any decisions. It just automatically happens. That's a phenomenal way to invest. And actually, in the United States, most small investors, how they invest in the stock market is through their 401k retirement plan.
Yeah, exactly.
And how they actually do invest in that are they're adding money out of every paycheck. Every 2 weeks, it automatically goes in the stock market. They don't have to do anything. That's the huge majority of how people invest in the United States. So there actually is quite a bit of dollar cost averaging that takes place. It's the stuff that you have to do on your own that is so much harder and so easy to underestimate how you are going to feel when the market is declining.
Great, thanks. So the second question, and this is obviously, since you're a big student of history, what we've seen is, if you look at the wealthiest people in the world, they've made their wealth over the last, say, maybe 50 or maybe maximum 100 years. Why don't we have, wealthy people from the 1800s or the 1700s? What happens during such a long time frame? Why doesn't compounding work?
Well, there are very wealthy people during the 17 and 1800s, the Carnegies, the Rockefellers and whatnot. I think what is great about this era is that now we have the opportunity for average, ordinary people to achieve long-term wealth, because around the world, you have low-cost passive indexing. That did not exist 20, 30 years ago, to say nothing of 100 years ago. So I think the era that we're living in now has the highest chance in all of human history for ordinary people to become wealthy. That's true in the United States. I think it's true in India. It's true all over the world. Doesn't mean it's easy. Doesn't mean everyone who wants to do it can do it. But the highest odds of it occurring that have ever existed in human history. I mean, if you go back to the 1800s or the early 1900s, wealth was so concentrated and opportunity was so concentrated among a very small number of individuals, the robber barons of the day, that, look, it was not impossible. There's always going to be stories of ordinary people achieving great fame and fortune. But the odds, I think, are so much higher today, particularly in a digital era where it almost doesn't matter where you live or who you know, or whether you live in New York or Mumbai or Los Angeles or London, doesn't necessarily matter. In a digital era, like, what matters is your talent, your meritocracy. So I think, like, that's a huge reason for optimism today and looking forward, is just the odds of becoming wealthy from investing or entrepreneurship, whatever it is, I think are greater today than they've ever been.
Great. So the next question is, about, what are some of the things that are at least happening in today's market that, make you wonder and, question, a lot, like maybe some guy, because, we are in a bit of a very, very sort of unique phase in, especially in the markets today. So anything that strikes out to you that's very interesting?
Nothing that really worries me, but I think it's so obvious that if you look around the market today, that there are investors who play very different games from one another. And if you are a passive indexer over time, that's one game. But you can also be a day trading meme stocks, and that's another game. You can be a high frequency trader. That's a completely different game. You can be a concentrated stock picker. That's a different game. And so we're all on the same field, so to speak. We're all on the same pitch, but we're all playing very different games. And the danger, I think, that exists, that is maybe more dangerous today than ever, is that if you are a long-term passive investor, but you are watching what's happening with people day trading meme stocks, with all the craziness that's going on with meme stocks, and you start taking your cues from those people, and you start saying, maybe they know something that I don't. Maybe that's what I should do with my money as well. And you start like mixing games apart. And if you are a long-term investor, but you're taking your cues from those people, it's easy to fall into traps that a lot of investors fall for. This is really true during the peaks of bubbles when, if you are a day trader, then the valuation of a stock does not matter. Whether a stock is completely overvalued makes no difference to you. All that matters to you is that stocks are going to go up. That's the only thing that's important. But if you're a long-term investor and you're looking at the price action in those stocks and saying, maybe these people know something that I don't, maybe I should buy this company, that's when people really get into trouble. It's when people haven't gone out of the way to define what game they're playing and only take their information and their cues from people who are playing a similar game. And I think the spectrum of games that investors play these days is wider than maybe it's ever been, from the day trading meme stocks to the passive investors. And both of those ends have attracted a ton of money. There's trillions of dollars in passive indexing, and there's millions of new accounts on Robinhood that are day trading the craziest companies you can imagine. So kind of both ends of the spectrum have really grown considerably over the last decade. And it's just dangerous when those investors don't understand that they are playing different games from one another.
Great, thank you. I really loved your segment on expectation management, how it's extremely important for someone to generally be happy in life. I think, but looking at maybe talking from a different lens, one is how do you keep expectations in check, because I think a lot of I would say envy is sometimes required to push humankind to do things which are a lot more riskier, and maybe to push ourselves towards more innovation and just becoming a better species overall. So do you think that there's some way we can push ourselves but also keep expectations low?
You're absolutely right that the outside benchmark of comparing yourself to other people is the fuel of a lot of progress. Yeah. Like the need to chase whoever is in front, try to do better than them. That's the fuel of all progress and advancement.
Exactly.
So there's that element. But I think at the individual level, it's undoubtedly true that rather than the external benchmark, you want to be focusing on the internal benchmark. Because if your definition of success is just that you are better off and wealthier than the next guy, there's always going to be someone who is getting richer faster than you, who is better looking than you, who is smarter than you, who is more talented than you. That's always going to be the case. And if that is your only definition of success, you need to come to terms with the fact that you are never going to be happy. You are never going to be satisfied, I should say. But if you kind of switch to the internal benchmark of just saying, what are my personal goals? Am I meeting those goals? Have I progressed over the last 5 or 10 years? Have I grown my income over the last 5 or 10 years? If you're focusing on that internal benchmark more than the external benchmark, or just going out of your way once in a while to the internal benchmark and how far you personally have come, achieving your goals, doing the best that you possibly can, even if other people are doing better, that's the only way to do it. So I think it's really just finding that mix between the two of being motivated by the success of other people and what other people are doing. But it's still at the end of the day, looking yourself in the mirror, measuring your success in how far you've come individually. It's not an easy thing to do, but I think striking that balance is so important. And very few people do it. I think the huge majority of people are anchored in solely on external benchmarks. Mm-hmm. And that's why if our standard of living around the world has increased so much over the last 100 years, are people happier today? The answer is by and large, no. Some people, yes, but by and large, no. Yeah. And I think the reason for that is because it's just so much external benchmarking in how other people are doing and people measuring their happiness and their success just relative to those around them.
Extremely true. I was trying to avoid this question, but I think we've got a lot of people asking this. But looking at it from a historical lens, since we had barter system, then you had a centralized currency. Now you have DeFi. How seriously should someone like me or someone else take it in terms of how important it can be in the future?
How seriously should you take it? I think you should take it very seriously. I think the odds, 5 years ago, it was easy to say crypto is a joke.
Yeah.
That was what people had said 5 years ago. That's probably what I said 5 years ago. I don't remember if I said that, but probably that's what I said. I think today, no one should be saying that. The amount of smart people who are in this field, the amount of belief that has gone into it, the amount of optimism that has gone into it makes it so that it's an actual thing. Like, is there actual intrinsic value of Bitcoin? Intrinsic value? No. But if enough people believe that something is true, it actually becomes true. And so many people, enough people, a critical mass of people have so much faith in something like Bitcoin, just to use it as an example, that it has real value. And I think it will for a long period of time. That doesn't mean it can't fall 90% as it has a couple times in the past. But so many people believe in this system. So many of the smartest people are devoting their career, devoting their lives to making this work. And there's so much capital going into it that no one should be thinking that this is just a flash in the pan, like a puff of dust that's going to go away. That's not the case. There is also a long-term history, I would say, of whenever you have a promising industry, actually picking the winners that are going to come out for that is a completely different thing. I mean, the example from the car industry in the United States, if you go back to the early 1900s, there were 2,000 car companies, and those ended up as 3 car companies. 3 car companies made it, GM, Ford, and Chrysler, 2 of which went bankrupt. So even if you find a promising industry, finding the winners from those, the long-term winners, is completely is a totally different thing. Same thing with computers. Like, who are the winners? The winners were not Commodore Computer and IBM, at least over the long term. It was companies that no one was talking about 20 or 30 years ago, from the internet, Facebook and Google and whatnot. Microsoft is probably the sole example of like a industry leader that has been relevant for more than 30 years. That's a very rare thing. So finding a promising industry and finding promising long-term investments are very different things. So DeFi and crypto is not necessarily my space, but 5 years ago, I probably would have laughed at it. And now I definitely would not bet against it, even if I don't own any per se.
Great, thanks. So we just wrap up with one last question. And this comes from portfolio management. I think as a financial advisor, as someone who advises people on how to set up their investments, the biggest I would say problem I get is convincing people to not speculate. Inherently, our genetics are all sort of built towards speculation. So my I would say conclusion is that you should maybe put 90% of your wealth towards something which is long-term passively managed products, and then maybe you can speculate or try out with those 5 or 10%, because it's very hard for you to say no to something that inherently you want to do. So what would your advice be for someone who wants to do portfolio management but also wants to I think try out his hands on speculation and stock trading and all of that?
I think you're absolutely right. Here's how I would frame it.
Yeah.
Your investing success is all going to be determined by how long you can stick around for, how much you can endure, how long you could actually invest for. And if day trading, creating crazy penny stocks is going to satisfy an urge for you and scratch an itch for you so that you can actually leave the other 90% of your investments alone and let them compound, that's a great thing. Like, there's so much evidence that an imperfect investing strategy that you can stick with will outperform a quote unquote perfect investing strategy that you're likely to abandon. And so if there are people that really have an urge to speculate and trade, and I get that, there's no criticism there whatsoever. I like that too. Just as long as you're doing a small portion of your money and satisfies your urge, and that the majority of your investments are really for the long term where the odds of success are firmly in your favor, then I think that is a perfectly appropriate way to invest. I'm not the kind of person who is like such a purist that they say every cent that you have needs to be investing appropriately. An imperfect investing strategy that you can stick with is always going to beat the perfect one that you can't.
Great. No, thank you for the insights. I think thank you so much, Morgan, for being out here and delivering your insights. This was a great session, and we're obviously looking forward to more sessions from you. So thank you so much.
Thanks so much for having me. I appreciate it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.